Peter Cardillo, the chief market economist at Spartan Capital. We're also being joined by Arnab Das, the head of EMs and macros and Invesco. Arnab, let me come to you first. You're seeing a massive seesaw on Wall Street. Dow gives up 20,000. It's now trading above 20,000. Call it technical correction. The markets just don't know what to do. But if I look at the global equities, yes, you're in a mixed bag in Asia, but look what's happening with gold. Look what's happening with crude. Look at all the asset classes. Can I safely assume that as of now, with all the uncertainty, the coronavirus, the avalanche of cases that you're seeing still in a couple of countries, investors worldwide are pulling out and hoarding cash?
Yeah, I think there's a real dash for cash going on, not just by the investor community, but in many countries by corporates and by the household sector. And there's been obviously a very big shift in the last several days in the patterns of consumption as well, right? So households have shifted from, let's say, discretionary purchases or durables purchases towards basic necessities. And so not only is there hoarding of cash, there's also hoarding of stuff going on as people sort of try to hunker down for what might be a bit of a lockdown that goes on for a period of weeks or months. So I think the markets are sort of being whipsawed around by all of this because there's been such a sudden, sharp shock to economic activity, which is quite a bit different than what we've seen in previous shocks, right, at least recently. So most of the shocks tend to go from the Fed tightening to or the central bank tightening to the financial sector to the real economy. Here, this one is going in reverse, right? It's starting from this sudden, unexpected problem that the coronavirus epidemic, which broke out in China, spread around Asia and then propagated to the rest of the world, particularly Europe being the epicenter now and feared that the epicenter will move to the United States. We're seeing this kind of behavior spreading as people start to react to the idea that lockdowns are taking place in Europe in the way, maybe not to the same degree, but in the same direction, the same way that they were taking place in China, and that's now starting to happen in the United States. So everything is being shifted around by that.
Right.
Now, of course, sorry, go ahead.
Right. Let me just get in Peter Cardillo also on that. Peter, hi, good evening. This is Ruchi from New Delhi. We're seeing the kind of policy response that the governments now are going ahead with in the aftermath of the coronavirus outbreak. In the US, we're looking at a possible $850 billion economic stimulus package. Besides that, the French President Emmanuel Macron has also promised a mega stimulus package for their own economies. Is that kind of a policy response is what is needed at this point of time? And that would mean that governments across the board will have to move into an expansionary zone.
Well, there's no question that, governments around the globe are throwing tons of money to the market and making sure that there's plenty of liquidity and making sure that the recession that we're probably already in doesn't get to levels that could turn out to be a prolonged recession that might even take a year or 2 years to snap back from. So I think whatever, all of the stimulus packages that are being enacted by the governments, and in particular here in the States, should help. But of course, it's not a question of if we are headed for a recession, but how steep of a recession are we going to be experiencing? And I think if you look at even some of the macro data that came out today, certainly suggests that a recession is here. Look at the retail sales data that came in; they were down by 0.6%. And remember that this does not factor in the present situation. So the consumer is definitely going to be overly cautious. He's not going to carry the U.S. economy for a while, and we see that even in other numbers. For instance, the housing confidence number, which actually came down, and I think that probably can be already attributed to the fear factor of the coronavirus. So, yes, I think what they're trying to do, and I think will probably work, is to stem the markets from going much lower. The markets have discounted a lot, and and I believe that here in the States at these levels, and in Europe, by the way, they've probably already discounted a not a mild recession, but a recession that is no longer going to be a V-type recovery.
A deep recession with tightening covering. Arnab Das, let me come to you now. If I look at Brent, $29.76 a barrel at the moment. Saudi Arabia is talking about exporting a massive amount of 15 million barrels of oil every day. You know, having said that, with investors around the world, corporations around the world wanting to hoard on cash, when we hear figures like the Treasury Secretary in the United States will go to the Congress today with an $850 billion stimulus package, I can't believe I'm saying this. It doesn't sound enough to get the world out of recession. You've got Goldman Sachs flagging it off. You've got Chetan Iyer of Morgan Stanley today flagging it off that the global recession is here. It is underway.
Yeah, I mean, look, I think, one of the things that we all have to bear in mind as savers and investors and even as citizens is that even in a normal kind of, quote unquote, garden variety recession, the policies of the central bank and the Treasury do not offset that recession by definition, right? What they do is they cushion the downside and make it possible for the economy to kind of come down to a landing place and then recover afterwards by helping to smooth consumption, right? Now, this one is a much sharper shock than most others because there's a kind of, as many people are saying, there's a kind of sudden stop, or I would call it a sudden switch in the kind of activity that was taking place with a significant reduction in that activity, right? So clearly the fiscal stimulus, the monetary stimulus is not going to fully offset that blow, but it will cushion it. And then what happens from there depends on a couple of things, I would say. One is the public health response, how successful and how complete are we in containing the spread of the virus, and relatively quickly, let's hope and let's try to turn around the spread of the virus and to contain the infectiousness, to contain the infection rate, contain the hospitalization rate, contain the mortality rate, and to kind of buy time to stretch out the problem over time so that public health resources are not overstretched, and also buy time for the development of vaccines. Right? Now, of course, it is true that what you just said, that there's another significant problem here, but it's a two-sided problem that Saudi Arabia and Russia are starting or continuing what looks like an oil price war to try and affect each other's role in the oil market, and also the role of U.S. shale in the oil market. Now, for some parts of the U.S. economy and the global economy, and many countries, that is not going to be helpful. It's going to be damaging. But for other parts, it will be supportive, maybe not in the short term because people are going to be driving less, less transport, less flights, all of that. So it's not going to help. It's going to potentially aggravate the problem in the short term, putting a supply shock, a supply glut on top of a negative demand shock. But in the longer term, once we put a floor under the economy and put a ceiling on top of the virus, right, the reduction in the price of oil should turn into a significant tailwind for the global economy. And we're clearly not there yet, and there's a lot of uncertainty about how this will all play out. How long it'll take, if it can be contained to 1 quarter or 2 quarters, probably looks a bit more likely. And there's some risk that what will happen when the northern hemisphere goes back into autumn and winter next year. So there's a lot of uncertainty. But I think, in the time-honored way, right, markets are overshooting, policymakers are responding, and, eventually things will be okay.
Peter, let me get you on that. The fact is that the whole coronavirus outbreak has just, in that sense, begun. People are, everybody's been talking about, in fact, health experts are saying that it is yet to peak in a lot of countries. We've already seen that the policymakers have started announcing economic stimulus packages as well. This is really the start of it, and we don't know how much policy support would be needed in the days to come. There is a lot of pain in sectors such as tourism, hospitality. How much more will the policy makers have to do, and for how long, more importantly?
Well, I really don't know how much more, at least here in the States, how much more they can do. The Fed has taken drastic actions. We have zero rates we have interest rates near zero. They have specifically said that they don't believe that negative interest rates would be good for the United States. And I concur with that because negative interest rates does very little. But the only thing that they can do is continue to proceed with quantitative easing. That certainly helped us back in 2008. Remember that the 2008 crisis certainly was different from this one because that was a financial crisis. This is a health crisis that's really going to basically stop businesses, at least small businesses, from operating as we get more and more curfews and people are told to stay away from restaurants, et cetera, and all of that. So that's why I mentioned before that the consumer is going to be hibernating for some time until we get a peak level with the coronavirus. But let me get back to OPEC. I think what's going on with OPEC between the Saudis and the Russia is just a lot of hot air. And very shortly, they're going to have to begin to make some serious production cuts. With the oil price at such low levels, that's only going to worsen the situation. Low oil prices and even lower oil prices from here would only be a real sign of real economic weakness. So I think that threat is probably not going to come to fruition. And I believe that just like the Saudis need oil revenues, the Russians need them just as much. And so I think that one of these mornings we're going to wake up and we're going to see that the Russians and the Saudis are going to be on board, and they're going to have to make some real massive productions to get the oil market in balance and prevent a real collapse in prices that we could be looking at anywhere from $15 to $20 a barrel.
$15 to $20 a barrel. That's the kind of oil shock that we're talking about. We began the year at $65. Right now, you got Brent trading a tad below $30. And we are hearing a lot of experts believe that it's going to hit 20, if not go down to the teens. What we can say is that's great news for the Indian economy, which is a net oil importer, the kind of forex that we spend annually. And could oil actually turn out to be the saving grace for the Indian economy? So far, we're still waiting for the Indian government to react. You're hearing about all kinds of stimulus packages from France to Japan to the United States, but India right now making sure that we don't have an avalanche of cases as far as coronavirus goes. Arnab Das, if I could come to you now on this very point, is oil going to be the saver for emerging markets in 2020? Is that what countries like India, specifically India is what I'm interested in, will have to rely upon? So far, we don't have any word from the government or from the Reserve Bank on how to tackle coronavirus.
Well, I think for India and China and some other emerging market countries, the collapse in the price of oil will help because they are obviously major net oil importers. And India certainly stands out as, requiring all the support that it can get because the economy had been autonomously, slowing down as well because of the issues in the financial sector. So I think oil is, the fall in the price of oil, taken by itself is helpful. I think against that you have this problem that there's obviously, as we've just been discussing in a way, a significant amount of risk off in the world. And India is a twin deficit country with current account deficit and a fiscal deficit, which has been partly financed, the fiscal deficit partly financed from abroad. And we are in an environment of dollar strength, right? There seems to be quite a strong dollar shortage in the world because of this kind of dash for cash, primarily in dollars that we were discussing earlier. So I think the oil effect helps, but it doesn't solve the problem. And I do think that the government needs to act much more expeditiously on the kind of macro front and as well on the reform front, right? So the banking system needs to be addressed. This is a very good moment to pursue major structural economic reforms if the government can bring itself to do so with Parliament. So the famous old issues of land acquisition and labor market reform, probably very difficult to do, probably not going to get very far, but maybe it could be achieved in a way through the idea of special economic zones to get investment and get the economy moving again in a way that would stand out in the world economy. Now, will that happen? I don't know. The government has multiple issues to deal with, and India doesn't yet, and I certainly hope and expect that it will not have much of a coronavirus problem. But if that does start to happen in India, that could be another major challenge. Right? We're not there. We probably won't get there, but it's something to bear in mind.
All right, on that note, Arnab Das as well as Peter Cartlow, always a pleasure chatting with you and getting in your perspective. And as we speak, we're seeing the seesaw trade on Wall Street, despite the U.S. administration promising a mega economic stimulus. And not just that, look at what's happening with crude as well. We're way below, once again, the psychological $30 per barrel mark. And as Nentar was pointing out, there are expectations that we may just see crude prices in the teens if the demand continues to slump this way, and of course the fears of a global recession as well.